I think all roads lead to gold when you look at it. We need the price of gold higher. We need the dollar weaker. We need defense industrial production back here. We don't want to be reliant on the Chinese to both finance our military and make our military. It's a bad idea. The only release valve is gold. Where's it going? I think it's probably going 15 to 25,000. The United States has probably never in its history, its number one export, be non-monetary gold for 2 straight months. Where's it going? Well, it's mostly going to Switzerland. Okay, well, that makes sense. It is the refining hub of the world, right? Where's Swiss been exporting gold to? China, the UAE, Turkey, India, and France. And Hong Kong, too. What that tells us is America is exporting gold through Switzerland to China. China imported 975 tons on net of gold last year. It values that gold to balance their trade at $38,220. China runs a flat balance of trade. What's the implication? The dollar gets waylaid.
Right.
The gold is now the reserve currency. The Chinese have been telling their people to buy gold since 2002. So the balance sheets of China and their banks, which need some repairing, given what's happened in real estate there, is going to go up a lot. I think all roads lead to gold when you look at it, whether it's deflation, whether it's inflation. We had deflation with where we are. You quickly have credit risk to Western sovereign bonds, Western bond market, and that's not going to be allowed to happen. If you have inflation, obviously. And so really gold is nobody's counter. No, gold owned in physical form or an allocated physical form is has no counterparty risk. And that's basically one of the only assets that you can say sort of has that, a monetary asset, certainly. So I think that's exactly what we're in the early days of watching, which is just this awakening to it's not that they've run out of room to kick the can. They can always kick it further, but they can't kick it any further without really debasing the currency.
Okay. I interview regularly Andy Schectman, who's the co-founder and CEO of Miles Franklin. I don't know if you know Andy or not. My opinion, very knowledgeable guy about just the internal plumbing of the bullion market, because he's in there on a daily basis, buying, selling, et cetera. And he has really been shocked by the flows of bullion in and out of the major exchanges like the LBMA and the COMEX. It's just at higher levels he's ever seen in his career. And not only are the volumes unprecedented, but the amounts that are being stood for delivery are unprecedented. And some of them are so high that he has trouble thinking it's anybody other than a sovereign player that's able to basically kind of purchase that much and take that much delivery in one fell swoop. Does that surprise you in any way, or does that make sense to you that countries out there are, yes, their central banks are buying them publicly, but also kind of on the sly, they're just taking more and more of this stuff?
No, it makes perfect sense. Something we've highlighted for clients 2 or 3 times in the last 2 or 3 weeks has been the United States' single largest export in October and November, which are the latest trade data, was non-monetary gold. And the Forbes magazine, their trade editor, wrote that was the last week. He wrote that those are the first 2 consecutive months in at least 20 years and probably ever that the United States' single biggest export was non-monetary gold. It was, just by way of comparison, it was bigger than aircraft. So we
Okay, and
sent
sorry,
more.
just to help a slow mind like mine understand this. So it's not an import of gold to America, it's an export outside of the country?
Well, just in that direction, yes.
Okay.
There's imports coming in too. But I think it's really important signpost from the standpoint that, like, we've never seen this before
Yeah.
in terms of the size of these flows. Earlier, in the first quarter of 2025, a year ago, we had so much gold coming in here in the first quarter that it literally turned GDP negative by like 4 percentage points. So you took a
Right.
$30 trillion economy and turned it negative 4% because that's how much gold was coming in. So from, where? Mainly the UK, I would suspect, but who knows? So we've seen these flows pick up, and the question is why? Why is the United States exporting a bunch of gold? And maybe more interestingly is where. So when you look at the data, where, the United States has probably never in its history had its number one export be non-monetary gold for 2 straight months. Where's it going? Well, it's mostly going to Switzerland. Okay, well, that makes sense. They're one of the biggest it is the refining hub of the world, right? 90% plus of global gold refined is refined in Switzerland. Okay, well, let's now dig into the Swiss numbers. Where's the Swiss been exporting gold to?
Yeah.
China, the UAE, Turkey, India, and France. And it's the Chinese and then Hong Kong too, which is also China.
Right.
And so to me, what that tells us is America is exporting gold through
Okay.
Switzerland to China.
To
Why
China.
would we be doing that?
So the global flight of ounces of physical from west to east continues.
It does, and it makes me wonder, right? What happened in October? This is purely speculative on my part. Remember, the new trade deal went back into place in October,
Hmm.
and our leaders got up and told us, "Hey, the Chinese have resumed sending us rare earths and critical minerals." If I'm the Chinese, I ain't taking paper anymore for that stuff.
Interesting.
I think some element, and forget out what I think. De facto, America runs a huge trade deficit. That is a fact. Another fact is that our biggest export for 2 straight months in the 2 latest months of the data, beginning when a trade deal started, was gold. De facto, the United States settled part of its trade deficit in October
In
and
gold.
November in gold. And I think that is when you listen to what U.S. officials like Trade Representative Greer and others have said, including at Davos, Greer came out and said, listen, we're going to start settling. We want to move towards a Hamiltonian economic system with a neutral reserve asset. I think part of the reason we're seeing gold's price move is I think trade is bidding up gold. When you look at U.S. trade deficit and compare it to the size of the global gold market,
Uh-huh.
the U.S. trade deficit dwarfs it. Dwarfs it. The price has to move so much.
Can I ask a really basic question here? This might be naive, but this is fascinating. So, assuming that's true, right? That they're moving to this model and would like to have this neutral asset to settle trade in, it would benefit the government to have the price of that asset increase because it means I need to give you less ounces in return for whatever I'm buying from you, right? And so historically, people that have followed the precious metals industry have grit their teeth, I think, for understandable reasons that precious metal prices are suppressed because the government wants to keep it down. It doesn't want to, have it reflect the decline in purchasing power of the US dollar or whatnot. Could this be flipping the script where all of a sudden the government actually wants a higher gold price?
100%. I think it's exactly what's happening. I don't think people have understood why the price of gold has been managed and suppressed for years. And it was to direct flows into US financial assets and in particular to treasuries. If gold got too big relative to the treasury market, then that's going to create a network effect for gold.
Gold's recent rally isn't merely a burst of investor speculation. It's the consequence of deepening trade imbalances forcing prices higher. As Luke Gromen points out, the U.S. trade deficit now exceeds the entire annual global supply of gold, meaning each incremental dollar of deficit places direct upward pressure on bullion. For decades, gold prices were implicitly restrained to favor treasuries and other financial assets. But as the system shifts toward gold as a more neutral settlement asset, those incentives reverse. What once capped gold now supports it. For investors, this suggests not only higher long-term bullion prices, but also potentially lower downside volatility relative to other financial markets, as government policy may increasingly align with gold's strength rather than oppose it. Next, Luke Gromen explains why this transition fundamentally reshapes U.S. debt dynamics and global currency flows.
It's not going to flow into treasuries. It's not going to flow into U.S. stocks, and that's ultimately going to result in a weaker dollar. It's going to result in weaker U.S. demand for U.S. treasuries. It's going to result in higher rates. Well, think about what this administration and the Biden administration before it, what do they want? They want to make more stuff here. They want a weaker dollar. They want all of they don't want the Chinese buying our stocks. Okay, well, if we don't want the Chinese buying our stocks, and the Chinese don't want to buy our treasuries, as we saw from the headline today, even where they're openly telling their banks to reduce exposure to treasuries. And the Chinese, by the way, said we're going to stop buying treasuries 13 years ago in 2013, and really have been winding them down ever since. The only thing left over to big enough is gold. And so I think exactly, I think it's a win-win where, okay, Chinese, surpluses against the US on the margin for at least some goods go into gold. Price of gold goes up a lot. The Chinese have been telling their people to buy gold since 2002. So the balance
Right.
sheets of China and their banks, which need some repairing given what's happened in real estate there, is going to go up a lot.
U.S. dollar weakness and shifting treasury demand are increasingly linked to China's decision to recycle its trade surpluses into gold. As Luke Gromen points out, since China began reducing its exposure to U.S. treasuries in 2013, gold has emerged as the only asset large and liquid enough to absorb those surpluses at scale. This strategic accumulation strengthens China's balance sheet while simultaneously aligning with U.S. policy goals such as reshoring industrial production and allowing a weaker dollar. For investors, the key is to watch gold not merely as a reserve asset, but as a strategic one, especially as traditional financial instruments lose influence. As Groman emphasizes next, this realignment places gold at the center of the evolving U.S.-China economic strategy.
That works for them. They can control that asset. We're not going to steal it because it's in their country. That works for them. It's inflation protected. That works for them. And for the Americans, we need a weaker dollar. That works for us. We want to reshore it. Got to have the weaker dollar before we do that. We want the Chinese out of our country. That does that in terms of their money buying our assets. That works for us there. And, the nice little kicker at the end of it is once a gold price gets high enough, there's a provision on the books. Treasury can revalue the gold. It's just money creation using gold and buy back most of the Treasury market, certainly the duration. So you can control long end rates. It's a win-win-win. I think gold is the unspoken pivot of any deal that might already be struck, at least in the framework between the U.S. and China. It has to be. It's the only asset big enough. And critically, for who cares what I think, watch the flows. It's happening. Watch the price. It's happening.
God, this is so fascinating. So a ton of questions coming out of this, but I guess first and foremost, gold and especially silver just had, massive price run-ups.
Gold isn't just another commodity. It has become an unspoken instrument in the economic alignment between the United States and China. As Luke Gromen explains, elevated gold prices give the U.S. Treasury an indirect lever over long-end interest rates through revaluation, effectively turning bullion into a quasi-policy tool. For China, accumulating physical gold offers security, inflation protection, and strategic independence. For the United States, higher gold prices help support a weaker dollar and reinforce efforts to reshore domestic production. Investors need to recognize that gold flows today carry geopolitical significance, not merely market momentum. Next, Luke Gromen explores how these price surges set the current cycle apart from past gold bull markets.
They've had a correction. Gold's hung in there actually surprisingly well. It's back above 5,000. I think it's close to 5,100 the moment we're talking here, Luke. And one of the fears that has been expressed over the past week or so is that correction's been going on is this going to be like what we saw in 2011 or in 1980, where we had this blow-off spike and then basically we gave it all up and then the precious metals just kind of did nothing for a long time. I think you think this time is different for the reasons that you just mentioned. True?
Oh yeah, it's night and day. It's apples and oranges. We were trying to get gold out of the system. We were trying to get the world to buy our treasuries and get, recycle their surpluses into our financial assets and get our factories out in the process. That's what we were trying to do in 1980, and from a policy standpoint, and from a in 2011, we were trying to sort of maintain that system. It's a matter of national security for the United States for the price of gold to go up, not down. In 1980, it was a threat, starting to become a threat to national security if it kept going up.
This correction isn't a replay of 1980 or 2011. It reflects policy-driven resilience. As Luke Gromen points out, unlike past cycles, gold today supports national security objectives rather than conflicting with them. In earlier periods, gold accumulation competed with treasury financing and industrial priorities. Now it complements reshoring efforts, supply chain security, and dollar stabilization. Prices holding above $5,000 suggest that strategic demand is absorbing volatility instead of allowing a disorderly collapse. Investors need to recalibrate their expectations. Bullion has become a policy asset, not merely a hedge. Next, Luke Gromen explains why these dynamics point to a longer, structurally supported bull cycle in precious metals.
You can read as much when Volcker said gold is my enemy.
Yep.
2011, that was still, Wall Street still dominated policy circles in Washington. And so gold's going up and up and up and up. And hell, they didn't mind it 2008 to 2011 because it told them, it was giving off a message of inflation and et cetera. That helped them get out of that crisis. They needed to inflate for a while. But once it got to a certain level, they didn't like that as much in terms of the message. They need it higher now for multiple reasons. If they want to reshore, if America does not want China to make the majority of its weaponry for America within 5 years, then America needs the price of gold a multiple of where it trades today. 60% higher to a multiple, 160 to, I don't know, 400, 500% higher. I don't know what the right number is. I can offer different perspectives on that. But it is so different now versus those periods of time. Now, people say, oh, it's never different this time. It is. You're right on that level. It isn't different this time. 1973 to 2020 was the only time in world history where the debt of an insolvent sovereign served as the primary reserve asset for global trade.
Here's a smoother, more fluent rewrite with clearer flow and stronger coherence. The gold market isn't merely reacting to investor sentiment. It is being reshaped by national security priorities. As Luke Gromen argues, the United States would need gold-priced multiples higher than today's levels to realistically reshore critical industries and avoid strategic dependence on China for defense-related assets. From 1973 through 2020, global trade functioned on a reserve system built on effectively insolvent sovereign debt, creating deep structural distortions. That era is now ending. Gold is re-emerging as a strategic reserve asset, with its price increasingly tied to supply chain resilience and national security. For investors, this cycle is not driven by speculation, but by policy. And as Luke Gromen explains next, this reversal lays the groundwork for unprecedented demand for physical bullion.
That was the anomaly. We're just reversing that. And so it's really, I think, the biggest, in 2017, I called it the biggest mean reversion trade in history. A couple different presentations I did with gold at whatever, 1,100, 1,200, 1,300 bucks. So I think gold, I think it is different than the last 50 years, but it's no different than what it was the prior 5,000 years. And ultimately, when you look at the imbalances as they exist, the United States needs gold way higher than it trades today. But by way of comparison, people say, well, oh, China, mercantile, and they're globalist, mercantile. China would sit down at that same table with Michael Every or anyone accusing them of mercantilism and say, look, we shipped all this stuff. And oh, by the way, we're not necessarily manipulating our currency. We've got factories that are like literally running dark, running on AI. We have made massive productivity enhancements. And so we're just more productive than you.
Yep.
And that's just a fact. But, Mr. Every, Mr. accusing us of global, and I'm not picking, Michael's a friend of mine, so here. But anyone accusing them of global, mercantilism, China imported 975 tons on net of gold last year.
What many dismiss as Chinese mercantilism is, in reality, a disciplined accumulation of gold as a neutral reserve asset. As Luke Gromen notes, China imported roughly 975 tons of gold in 2025, a clear signal of strategic hedging against dollar exposure rather than covert currency manipulation. For over 5,000 years, gold served as the world's ultimate settlement asset. The past half-century of dollar dominance is the historical anomaly, not the rule. For investors, this shift matters. Today's physical gold market is being driven by real-world trade imbalances and reserve strategy, not speculative cycles. Policy choices and productivity dynamics are now shaping bullion demand far more than headline-driven narratives. Next, Luke Gromen explains how this evolution is creating structural pressure on the dollar relative to gold.
And so if I'm China, and I suspect this is what they're saying to Trump and Bessent and what they said to Yellen before them, was listen, stop. We are importing 975 tons of gold. The issue is not us overproducing with the left hand. The issue is that you are overvaluing the dollar relative to gold with the right hand.
Mm-hmm.
We ran a 1.2. So think about this. The Chinese ran in 2024 a $990 billion surplus with the world. It was the biggest surplus in world history as a percent of global trade, global manufacturing output. Biggest ever, 990 billion. Okay. China needs to strengthen it. They're manipulating their currency. Blah, blah, blah. Mercantilism. Blah, 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 blah. The yuan strengthens sharply against the dollar. Biggest move against the dollar in a long time. First half of 2025 was the worst drop in the dollar in 55 years. And yet in 2025, guess what China's trade surplus with the world was? 1.2 trillion, up nearly 25%, despite a much stronger currency. Okay, what's the real issue? The real issue is the dollar's wildly overvalued against gold. And I highlighted this in 2024, I highlighted it again in 2025. If you take the $1.2 trillion trade surplus of China and divide it by the 975 net tons of gold they imported.
China's record trade surplus isn't about cheating. It's a signal of dollar mispricing relative to gold. As Luke Gromen notes, even after the yuan's sharp appreciation in early 2025, alongside the dollar's worst decline in 55 years, China's trade surplus still expanded by roughly 25% to $1.2 trillion. The deeper imbalance isn't trade policy. It's an overvalued dollar versus gold. To preserve real purchasing power, China is effectively forced to absorb close to 1,000 tons of gold annually. For investors, this reframes gold as the true global settlement asset, with currency fluctuations becoming secondary to the underlying flow of physical bullion. From this perspective, Luke Gromen then turns to the question that matters most: what this structural shift implies for gold's eventual price target.
It values that gold to balance their trade at $38,220. At $38,220, China runs a flat balance of trade. What's the implication? The dollar gets waylaid.
Right.
The gold is now the reserve currency. America, they whine about this. These American economists whine about this mercantilism. Listen, there's two sides of the same coin. If you want the Chinese to stop being mercantile, price your currency appropriately. The dollar is so overvalued against gold relative to what we make useful in the real world. And that's the issue. And so when we say globalism's over, yeah, I agree with Michael on that. What's that mean? I don't know if 38,220 is the price, but I think gold is going to somewhere between 5,000 where it trades today and 38,220 to balance the Chinese trade. That's until the dollar gets weak enough that people, say, hey, I can actually make more of a living as an engineer making something instead of like trading monkey JPEGs back and forth, or I can, day trade my stock account and make more than an engineer can. You get the dollar weak enough that we can make stuff here. And that's how you do all of those things. Is you settle in gold and you just let US's trade deficits bid gold to the moon until the dollar is appropriately valued, which is probably, I don't know, by the end of the cycle, I think DXY trades in the 60s, maybe lower. That's where this has to go.
Gold functions less as a simple commodity and more as the world's balancing mechanism for trade imbalances. As Luke Gromen points out, at roughly $3,820 per ounce, China could theoretically neutralize its trade surplus, an illustration of just how overvalued the dollar remains relative to bullion. Seen through this lens, U.S. deficits are not structural breakdowns but automatic engines of gold demand. For investors, the implication is clear. Until the DXY weakens toward the 60s, gold is likely to stay under persistent upward pressure. Price volatility will reflect strategic settlement flows and reserve adjustments, not speculative excess. From there, Gromen goes on to explain how this dollar revaluation cycle could realign manufacturing incentives and reshape domestic production.
And what general time frame are you talking about here? Because I just don't want folks to get the impression that Luke is saying, okay, gold's going to $40,000 an ounce tomorrow, right? So are we talking a half a decade? Are we talking 2 decades? Like just finger to the wind. What wouldn't surprise you?
See, I don't think it matters. Like, this is a problem with a lot of American investors. They only buy stuff when it goes up, right? American investors only buy stuff that goes up. Now, I think it's going to happen. I think it has to happen over the next 5 to 10 years. And you say, well, gosh, is that fast enough? Here's the reality. I put up a chart yesterday. It showed if you look at the S&P total return, right? So this is the S&P with dividends reinvested. Gold has outperformed S&P total return over 1 year, 2 year, 5 year, 10 year, 20 year, and 25-year basis. Basically, my entire career, I'd have made more money sitting in gold than in owning the S&P 500 total return. The only time it worked was in 2011. If you bought it 15 years ago, S&P total returns killed gold since then. Other than that, sort of every major and that was before we really started this change. Like, I think we are in the very early innings of it is a matter of national security for the US to settle.
Many investors fixate on timing, but gold's trajectory is shaped by structural imbalances, not short-term market noise. As Luke Gromen notes, across 1-2-5-10-20- and 25-year horizons, gold has historically outperformed S&P 500 total returns, with only limited exceptions such as the period following 2011. That record reframes gold as a tool for long-term wealth preservation rather than speculation. With the early stages of a national security-driven shift in global trade now underway, portfolios that ignore gold risk missing a source of systemic upside. From there, Gromen explains how viewing markets through a national security lens fundamentally alters expectations for future price ranges.
Trade deficits, at least partially in gold, because we need the price of gold higher. We need the dollar weaker. We need defense industrial production back here. We don't want to be reliant on the Chinese to both finance our military and make our military. It's a bad idea. And so the only release valve is gold. And so I think ultimately, look, where's it going? I think it's probably going 15 to 25,000 probably over the next 10 years. You know, when you look and say, okay, a triple over 10 years, that's not bad. A quadruple or a quintuple over 10 years, you take that all day long. Now, from here, I think it's going to be more volatile than it has been because I think we're getting into that part of the cycle. And look, if I'm wrong, then the Western sovereign debt is unsustainable. And oh, by the way, the only thing you're going to want to own in that case too is gold.